Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, September 7th, 2022. It is 10:47 Eastern Time as I'm starting the video. So we're a little over an hour into the trading day. I'm going to give you my thoughts, some things to watch. Um, and so, yeah, I've already got the wedges out to you this morning on the indexes. I picked up on those last night. We had some pretty clean downtrend lines. I'll get to those in a second. But here's where we're at. Let me start there since that's really the focus of this video. You have this is a zoom in shot, same chart, 1 hour. I cleaned the chart up, if you probably noticed, versus all the other trend lines I had on and support and resistance levels on the 60-minute charts I've been covering recently. So we zoomed down, still an hourly chart, meaning hourly candlesticks, but 1 month. And here's that trend line, the wedge line. So you have a downtrend line off this spike high right there. It comes in, you have a nice clean 1, 2, 3, and now 4 distinct reactions because we're on there. So this is what I always talk about waiting for a solid 60-minute close, candlestick close above to help confirm a breakout. Why? Because it is more than usual to see an intra-period pop. Now I still think we're going to get it, but we don't have it yet. You can look, and I'll zoom in real tight. I have not modified that trend line since I got it out to you. This is how this game works. Popped it, looked good intra-period, but that was the early morning surge. Especially always take the post-opening rip or dip with a grain of salt. What I mean by that, at 9:30 a.m. the regular session opens. There is always an imbalance of orders. That's why when you look at the daily volume, you see it looks like a smile face. If you put a 1-minute chart, you see a surge of buying in the open, it tapers off, bottoms out around noon, and then the volume bars start to pick back up. Take that form of a smile into the close. So you have a lot of volume, a lot of trades going on early because the regular session, the stock market's been closed all night. And then, so again, you always take that with a grain of salt, and then you wait for a close. So that you can see right to the exact button. And again, I have not touched that trend line since I got out to you. That's where we close that first 60-minute candle. So really no confirmation on the breakout, just an intra-period pop. Still looks good in my opinion, but there's something I'm watching, and I'm going to get to that in a second, namely the big FANG stocks, especially Apple. Second candle, we're right there. So this is what's happening. We haven't gotten rejected off there. We just haven't taken it out yet. That's NQ. So watch for that. You want to keep it simple. Once they've popped it intra-period, if they take out the previous high, even if it's intra-period, in other words, today's earlier high from this morning, that's usually going to do the trick. Otherwise, if we fall here, it's just another rejection off the trend line. That'll be the 1, 2, 3, what is that, the fourth reaction so far, and it'll be another rejection. And then you look at the support levels that are down below. Doesn't mean that we can't break out. As long as the divergences are in place and these wedges are nice and clean, there's still the potential that they will break out. Jump back 2 months, there it is. So there's your wedge lines. There's the next support. If we get rejected, 11,863. If we had a reversal down to that level today, if it happens today, one thing I can tell you, there's no guarantees the wedge will break out and run, but I can guarantee we'll still have the divergences because these indicators are making much higher lows. In other words, you just take the line down a little bit if we had one more thrust down, and it would look like that. Now, anything much more than that, then you start to go down and you have the potential, especially if you break support, to take those wedges out. So, all right. Oh, and by the way, remember, this was that the alternative uptrend line I had. It goes back to the left. And so if we pop that level, as I said this morning, you have the 120.56 price resistance. You can see, again, let's zoom in a little tighter. This is why I think we can run if we can just get above today's highs and break out above this wedge. It's not just the downtrend line. You also have some pretty decent support that was there. Support, finally it broke. And then this whole thing, that break of support, will prove to be a bear trap because there are active traders, I can guarantee you that see support levels like this and they short on that breakdown. So then if the breakdown fails, in other words, we move back up above 120.56 with conviction, the farther we get away from it, the more and more those stops are going to be hit, and then you have the potential making for a bear trap. So there's my targets. 12 245, we'll call it 12 245 50ish. always sell a little bit below if you're trying to game the bounces. And then, as I've been maintaining for a while now, still think we'll run up to these downtrend lines off the recent highs at minimum. That's also going to come in with that head and shoulders neckline I gave you. Remember, we had a left shoulder there, I had a right shoulder, and then that broke down when we took out the neckline. So those are all potential targets. And just let me try to measure it out for you. They all come in roughly together. You're not talking something huge, and we could certainly do more. But right there, that's just my near-term targets. It's a max bounce about 4.5%, give or take. And remember, I'll get to oil in a second. If oil and natural gas, if they continue to fall, as I suspect they will in the coming days to weeks, then that should be an added benefit because, again, it's going to be an abatement in the inflationary pressures, with oil and gas, of course, being the biggest drivers of inflation. Okay, that's that. Let me give you ES, the S&P 500 futures. There's this one's looking a little better. Here you go, breaking out. There's the downtrend line. Let me zoom in a little tighter for you. Get nice and tight here, and you can see the same thing. Again, I have not touched trend line since I got out to you. It's not modified. An exact close right on it, and that first candle after an intra-period pop. But there you go, and see this? We just took out the previous spike high from that first 60-minute candle of the day right there. So that one looks good, but it's NQ. You got to have them both. I've seen this time and time again. One breaks out and looks good, starts to run, but the other is going to drag it down. And the big concern that I have today, and I'm watching, is are the market-leading FANG stocks. It used to be FAAMG, and then you saw Tesla outgrow Alphabet or Meta, and you have Nvidia as a big one in there. So when I'm looking at these, by far the most important one is Apple. And Apple's red. It's been red all day, and it's kind of sucking wind. What I've seen in the last few days, to me, I've seen the cryptos get hit hard. They were hanging in there. And they do trade with the market, but they took a big down yesterday, as I pointed out. And just everything, just about across the board, broad-based selling. Remember, treasuries used to move inversely to equities, but lately they've been trading positive correlated. So what my read on the market was in the last week or so is very heavy institutional selling. Ever since Powell, and for the life of me, I can't figure out where their head was. These hedge fund managers, pension funds, but they sold, and individual investors sold when Powell said he was serious about fighting inflation. So whatever it was, they were long and dismissive of that until he actually had to come out and be very short and curt about it, and do a mic drop and then walk away when he was at Jackson Hole, leave the podium. And then so look, they sold. But again, to me, it was very indicative of looking at all those different asset classes and everything that the hopium crowd was chock full of and buying right here at the end when they should have been selling. That's just a crowded rush for the exit. So anyways, where I'm going with that is the institutional selling over or not? Well, I look at the biggest names, and Apple is the biggest of the big. This is the most widely held stock. I don't think there's a growth fund out there in the world that doesn't have Apple as a top holding. Pension funds, all that. Just because of its sheer size and weighting in the indexes. And so I need to see this guy turn today. And if we do, then the market should be good. So far, like I said, it's sucking wind. You've got the QQQ green by 0.5% right now. This is QQQ. The equal weighted is also up 0.5% right now. I'm going to tell you I have my real-time breadth indicator. It's on another screen. I'm going to click and sort percentage change. I did right before the video. It was 70 out of the 100 stocks. Right now it's 76. So 76, 3/4 of the stocks in the NASDAQ 100 are trading green right now. And however, Apple's not. So once institutions start stepping in and buying Apple, it should be smooth sailing, and that breakout will stick. I think it sticks. I'm long, told you that before. Added to those longs today on the because that breakout to me appears imminent. One reason I did as well is the breakdown in oil. I cannot overemphasize enough the importance of that, in my opinion, especially on the heels of the big drop we've seen so far in natural gas. And I want to show you this. as far as support goes, remember, all along, from back here, I was targeting right here. That was my target zone right there. We hit it dead center, smack in the middle. So that worked out. And then from that point, before we even got there, I said I'd swing it down to this trend line. Now we overshot my pullback target by a little bit, but there's still some good support. I also said all along that this is really good support. All these circles, let me just take these lines away and show you. This was, again, at the time, pointed out as an ascending triangle pattern. You had prices moving up, and you had a lot of resistance. You had gaps in there. There's a big old gap, reaction high, another reaction high, and then your breakout candle, and then a back test. And so that was and still is very good support. And the Qs are holding on to it by the skin of its teeth right now. So if they can rally, great. If not, it's just not good. It doesn't guarantee we're going to plunge down and have a strong drop to my next target on the final target on the weekly chart, but it certainly would increase the odds of it. But if we can bounce here, then again, the stage is set for a tradable rally. And think what you want. Like I said, try to, you have to have a bias to trade, to know when, whether to be long, whether to wait for a breakout to position long, or if you're bearish, you wait for a breakdown of support to position short, or you also short on a rally back into resistance. That's where, these people say, oh, just trade the charts, don't have any bias. It's hogwash. In my opinion. Good luck doing that. You're just going to second guess everything. So, you need to know if you're a bear, you say, hey, you know what? I'm going to bet that any breakout here is going to fail, and I'm going to short into that breakout. Just like this one. There's that previous wedge. And remember, that one got sold in too hard. It started to go, but all we did is set up an even larger wedge with even bigger divergence. And that even sets the stage for a larger rally if we can get a breakout, we can recover some of these levels, if that support level I just showed you holds, and if the institutions aren't finished selling. Right now, today, they're using this rally in the market. It's not a huge rally, but again, we're up 0.5% in both the S&P and the Nasdaq 100. And guess what they're doing? They're not buying. They're unloading their biggest holdings, which is Apple. Apple's down, Meta's down 0.5%, and Nvidia, one of the top components, also down. So I want to see a little bit more, broad participation in those big names, because again, that reeks of institutional distribution. And once Apple turns green, and if it can rally here, chart's still constructive. I've been pointing it out for a while. We had a wedge, but again, this was indicative of bear market action. You had a beautiful bullish falling wedge. Textbook, and a breakout. We did hit my first target. Somebody asked, and I gave you these targets before. But what happened? The sellers stepped in hard. However, they haven't foiled this pattern yet. Sometimes you break out and you never look back. You zigzag up, and sometimes you break out. That initial pop is faded, but then you put in, either you back test a wedge, or you put in this case, you just extended the divergence. I wish I had Apple at support. Right now on the 60-minute chart, I have just moderate or mild support down about 151, 156. So there's really no support level for the buyers to step in. And on top of that, in typical bear market fashion, it broke this primary uptrend line, or it wasn't a major uptrend line, but you had 3 reactions. So it was really the minimum I need to see. And this was the big sell signal back here. So like I said, I wish I could be a little bit more bullish on the Apple chart. Trend wise, yeah, it's still bullish right now. The PPO right here, the white line, the signal line's well above both the 0 line here and that level I have at about negative 1.18. And that defines trends. Bearish when below, Apple's bearish there, and bullish when above, and so you can see bullish when above, and still is. So like I said, maybe a little, there's the next big support, decent support on Apple. It comes in around 150, 160 to 150. So that's it. So it could be another failure to start, just like the last wedge breakout last week. We'll see. For now, I'm taking the wedge breakouts on face value. Again, I need to say it again. It's not confirmed yet with NQ. We still need to take, print a solid 60-minute close, take out the previous highs. So it's like I said, you can have an early buy signal right now on the fact that we popped it, but then we fell back down to it, like I showed you. You really want to see us power up, like I said, and take out the previous highs, and then print a solid 60-minute candlestick close above it, and that should bring in the buyers and start to squeeze out the short sellers. And I do favor that scenario. Like I said, just a little bit of work to be done. All right. Crude, I don't know what else to add to this. That's just, to me, the most. I've been talking about this support shelf forever and a day, and it broke. And yes, this is a daily chart. So yes, technically speaking, you want to see that daily candle close below there, or it could be a whipsaw. And yes, am I concerned that there is positive divergence? We had remember, we had a bullish falling wedge right there, and it broke out, but that failed. But now we're just back testing the bottom of the wedge. So that's a possibility. If that happens, that's not going to help the bullish case for equities. Most certainly not going to help, because that's going to be inflationary of crude oil. But if crude drops and makes that 14, 15% or so drop down to my 73, 76 target, that should certainly do a lot of the work that the Fed wants to see done, with the abatement and inflationary forces. So let me just pull that line out. Just tell you, as of now on the daily, there's still some positive divergence. If we can drop below there and take out the divergences, great. We could even keep them intact, and maybe possibly a quick thrust down and still hold on to those divergences. And I'll be looking to go long crude if that's the case, especially if the 60-minute charts tell me to as well. And natural gas, still doing what it should be doing. There was our big wedge there, little trend lines, little breaks, big drop after the big wedge break. Second wedge, there was our, we had an early sell signal back there, then one there, then one there on the break of 885, moving lower and heading on down to my next target there at 7516. So looking good so far. Maybe a straight, usually crowded rush. Usually you get a crowded rush for the exits on a lopsided trade. Everybody was bullish natural gas, and everybody thought. I mean, proof is in there that when Russia decided to just not turn back on the flows on the Nord 2, that could only be bullish. And like I said the other day, nothing is more bearish when what should be 110% bullish news for natural gas isn't. It just shows the reason, and it leaves people perplexed. How can natural gas possibly be tanking with that news? And it's just because it was a one-sided trade. Think of it this way. If everybody is bullish natural gas, or everybody's bullish Apple, then that means everybody's long, and that means they have their fill. They've bought as much as they have, as much as they have, money to buy it, or at least a portion of their portfolio they're willing to allocate it to it. So look at it this way, and don't take it literally, but also when the last bull has bought his or her share, who's left to buy? Nobody. And then you have nobody but natural sellers. And then when they start to see something fall when it should be going up, then they get stopped out and margin calls and all that good stuff. So we got to watch the intraday charts. Sometimes you get a little counter trend bounce. Here's a 10-minute chart. You get a little wedge, but you keep getting those. You had a little divergence there, and they popped. These little 10-minute divergences usually just get burned through in a strong. Remember, that was just a strong breakdown in that gas. So I don't want to beat a dead horse. If very, very open to this 701, 702 target right there as well. I just wanted to say that's the first target there, where the buyers will probably step in and we'll get a tradable bounce. So if that and the crude crude short continue to play out, then again, for the reasons I've stated repeatedly lately, that should be, and I put should in quotations, it should be bullish for stocks, for that simple reason that the Fed may not have to continue to raise as aggressively as they're talking about doing. One other thing, just a quick update on gold. I'm still liking gold, still long gold and silver. This is a 60-minute chart of gold hourly, one of my favorite swing trading time frames. A lot of lines, but most importantly here, you had a double bottom there. We came back, tested that 1697 level perfectly recently, and when we did it, it wasn't just a test of support. We had, you got it, positive divergence right there. bullish divergence. We ran up, put in a little negative, a little small divergent high, and I also saw a lot of pressure, selling pressure across the board. Just about everything was getting sold lately, which tells me it was a lot of institutional selling. But guess what? We came in, we made a higher low so far, knock on wood, but there's a higher low. Now we need to take out that high, and then we have the early makings, if so, of an uptrend, which is a series of higher lows and higher highs. And so I'm still targeting intermediate term targets all the way up here at 1824 as it was. It's been for a while. That's going to be from where we're at right now today. If hit, that's about 6%. And then you can expect silver to rally usually more than gold, and you can expect the miners to rally more than gold as well. So let me just cover those two and we'll wrap the video up. SI, I've got you down here somewhere. Silver, there it is. So silver has been getting sold out, burning through these divergences. But remember, silver will usually follow its big brother gold, and that's what it's doing today. So you had a little minor break there. Charts are kind of, I haven't updated this there, not really divergence, almost divergence, but gold had the divergence. Gold had the double bottom low. So if gold continues to rally, silver is going to continue to rally. And then if gold continues to rally, GDX will continue to rally. So there's GDX. Well, beautiful chart. I'm still very bullish, still maintain as I have all along these targets I gave you back here. Got in a little early on this one, but to me there's a difference of early and wrong. Wrong is you get in on a trade and it just continues so far down that you're stopped out. As long as the charts remain constructive, I will remain bullish and long miners and some long-term accounts. Positive divergences right there. We had a divergent low there, just like that little 60-minute wedge break in the equity markets the other day. They sold into it, and that may think, tell everyone, or may a lot of people, I'm sorry, may think that it's never going to play out. But when I see it comes down, that's it. They sold the initial pop, small wedge, and then created an even bigger wedge here. Probably, let me change this trend line color down a little bit. And now I'll show you, this is what we've got in GDX. You have this bigger wedge. So the little wedges didn't play out. They played out for a pop and then a marginal new low, still divergent low. And a lot of work to be done, but so you're looking at first targets about 20% above, second target's about 28%, third target zone runs for about 40 or so percent. And that fourth target, if hit, is going to be about a 50% rally in the gold mining stocks. And then I've covered this many times in the past, including recently. I'm not going to do it right now because then the video will go too long, but I've showed you a very strong correlation between crude oil and GDX and gold. Because remember, as I often say, this isn't 1849 anymore with gold sitting all over the river tops and creek beds of Sacramento and everywhere else. We've long stripped the earth of its surface gold, so you got to dig deeper and deeper, and it's energy intensive. Those machines don't run on solar power, they run on diesel fuel and gasoline, and so do the plants that have the conveyor belts and processing and sorting all the gold and then moving it around. And it's a heavy metal as it is, so it's an energy intensive process. So who benefits when crude prices drop? The miners. Who gets hit hard when when crude oil shoots to multi-year highs? The miners. They don't like rising oil, they like falling oil, and because it helps their bottom line. And of course they like rising gold prices, so it all goes together. So that's it. All right, I am going to wrap it up here, and that's it. So long and bullish equity still, short and bearish energy. And then commodities, just treat them on their own. There's some here and there, like wheat popped that level today. I'm just, you can trade wheat if you want, and corn, soybeans. I'm still looking overall, and there'll be certain ones that will do their own thing, but I'm still looking for an overall abatement in inflationary forces via the broad-based commodity indexes or ETFs like DJP. That's it right there. Still thinking we're going to come down here. That $31 target, that could be a short trade also. You want to short commodities broadly, but remember, when you do that, this is like the S&P 500 of commodity ETFs because it has everything. It's diversified. So if you have energy dropping, You might have the grains and oil seeds going up at that time, or precious metals. So, you short DJP, you're also shorting gold and silver as well, and industrial metals. So I like to selectively trade commodities personally versus a broad-based ETF. Just like I don't trade the S&P 500 for that reason. You go long if you're bullish the S&P 500. You're also long all 11 sectors, some of which are going to go down. They have a low correlation. It's just kind of mutes your returns. That's why I trade the Nasdaq 100. It's more of a pure play. It's just a tech play. It's like trading XLK. XLK, the tech sector ETF, and QQQ charts are going to mirror each other. You just have more liquidity. You don't have an XLK futures. So I like the futures, and that's why, hence the reason for trading NQ a lot. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.